It's just always like that. Just look for a way on how to read it correctly. Now, this thing might not be clear to you like this. That is why I use the line to explain. Now, after using the line to explain, we are going to go into the live market now to break it down to you, to apply all these things I have said here on the live market so that we can see how far it works, right? Let's go down to business. I am going to give you a minimal explanation using this chart, right? So what do we see here? First thing, to take the direction of the market. First of all, I can see that the market is what? Bearish. What information is telling me that the market is bearish? As it's because I have seen this break of structure. All right, I have seen this break of structure to the downside. All right, after a break of structure, this is a sell market trend. After the break of structure, what else am I looking for? I am looking for my swing high. If it was a buy, if it was a bullish market structure, you'll be looking for your swing low. But if it's a bearish, you look for your swing high. After marking out your swing high, what are you looking out for? You are looking out to mark your what? Swing low. Swing low. As simple as that, right? After you mark out your swing high, you mark out your swing low. What are you looking at? You are looking at your trading range. Now, this becomes your what? Trading range, right? You are very much interested in things that are happening inside of this trading range. This can be as long as it takes the market to break out of this zone. Now, this swing high is an external structure. This swing low is an external structure. What we are looking out for is prices in the 15-minute time frame. How to take leverage on the opportunities in the 15-minute time frame. So we go down to business immediately. After low on the 15-minute time frame, gives us a what? Higher low, a lower low, higher low, a lower low again, higher low, lower low, higher low, lower low, higher low, and so on and so forth, until when the market was ready to change its character to the upside. Then it started giving us, it gave us what? A break of structure here. It gave us what? A break of structure here to the downside. BOS, and then we expect that the market should come to somewhere around here and then respect this zone. But that is not what happened. The market gave us a spike up angle, disrespected this zone by what? Breaking to the upside, causing this place to become our change of character. I hope you understand what I'm trying to explain, right? Give us our change of character. So what do? We come to this place here, we look for what? Entry models. Come to this place, look for a point of interest, and what? Look for a way to what? Buy to the upside, right? That is how we make money. Pretty simple. Let's go back to the 4 hours time frame. So let's now go and look for an entry model, then play the market to see how it actually works, right? Let's focus on this entry, on this trading range now. Let's focus on this trading range. Just picture this. Focus. Let's go to the 15-minute time frame before I remove the rectangle. How big the rectangle has become, because what? We have expanded it to the 15-minute time frame to have what? A detailed explanation of things that are going on. I'm going to remove this rectangle now to make things more clear. From the 15-minute time frame, what are we seeing? We are seeing that when the market gets to this place here, being the highest point, it gives us what? A series of what? A break of structure. And when you check here, it gives us a change of character. That indicates that the market has started going down. So having understand that, you start seeing the market giving us lower low, lower high, 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 lower low. Then what did you see here? We see that the market actually shifted. Pay close attention, very, very close attention. This is where things get pretty much confusing. If you are confused here, it means that all this explanation I've been making since, you miss everything here, right? What I want you to understand that this series of lower lows and higher highs and lower highs are a series of what? break of structures, right, are a series of break of structures to the downside. Break of structure, another break of structure here, another break of structure here, as the case may be. But this is where I want you to pay close attention. In the 15-minute time frame, we look out to get a very clear explanation of what the trend is doing, right? So when the trend gets here, we see that it gives us what the last break of structure to the downside. This is the last break of structure. After this break of structure, what happened next? We got what? A change of character. This change of character, what does it tell us? It tells us that what the 4 hours time frame has decided to change its character from going down, that's bearish, to going up, bullish, right? So this becomes what? Our change of character. After the change of character, what are we looking out for? We are looking out for swing high and swing lows. This is where the second concept comes in, right? Point of interest. What is point of interest in simple terms? Point of interest is the area that you want a pullback to come into before you consider buying or selling. This is where I introduce you to the Fibonacci tool. The Fibonacci tool gives us the concept of buying at a discount and selling at a premium price, right? Now, let's take for example, this is our current price range, then this is our swing high. This is our swing high, and this is our swing low in the 15-minute time frame, right? What we are looking out for is to buy from a discount level. And what is that thing that justifies a discount level? Now, this here is our trading range. We are looking out to take trade opportunities from this place, right? Then, having known that this is our trading range, we move forward to look for our point of interest. For a point of interest to be valid, it need to come to this 50% break. The whole length, the whole trading length, this is a length, right? So we need to like at least half of this trading length. When I say half, this becomes what? This becomes our discount. Discount, that is the place we want to buy from. This becomes our premium. That is the place that we want to sell. When you buy, everybody loves buying something at a discount rate. Alright? When you understand that, you understand better what I'm trying to explain here. Everybody wants to buy something at a discount rate. So this here, if the market comes back and then cross this 50% line here, you know that the market has fallen into a discount. So we need to start looking for a way of how to buy from a discount level to the premium level. The premium level is where you take your profit, right? That is where you go out of the market. Everything you bought from the discount, when you come to this place where you sell it and you make your profit. As simple as that, right? That is normal real life analogy, right? So let's take this mentality now back to the chart. So we have seen that this trade have actually met our 50% discount criteria. Then what do? We look for a point of interest. A point of interest is the point where you would love to take your discount from. That is what will take us to our next topic, which is what? Candlestick. A candlestick are a combination of candles. This is actually a candle. The reason why I'm starting with the full concept is to make us understand what we are looking for. Then I will go into deep detail on how to explain all these things. Candlestick, how a candlestick form, the hours and the minute it takes a candlestick to form completely. All those things I will explain them. But then you need to know why we want to go and learn this detailed explanation. We need to learn it so that we can apply it to fit into this explanation carefully, especially for the beginner. All right. So we go to the higher time frame to look for our point of interest. After confirming that the market has shifted from bearish to bullish, we need to look for a point of interest. From the 4-hour time frame, the only point of interest I can see here clearly is this point, the last sell before they buy. And now most people that pay for mentorship, all they get is after the break of structure, they just look for anywhere around the chart, enter the market. From here, they target this zone, or this zone to take their profits. This is a 4 risk to reward ratio trade. It is pretty much good. It doesn't have any problem. Good. It is a very good trade. 4 risk to reward ratio is very good in the market, but this will take a long time and then a short reward. I earlier told you that we are here to upgrade how things have been operated. We are going to look for a more suitable way of entering the market. Come with me, let's go, guys. So let's remove these and then focus on our business. Now we have looked out for our point of interest, that if the market should come to this place now, buy. Let's go to the 1 hour time frame and see if there is any relationship we have with that point of interest. Okay, there is a little relationship here in that point of interest. We see a bearish and a bullish candle here. So if the market should come back down to this place, we'll start looking for how to buy from here and then get to this place and then sell. So after this, now we are going to go back to the 15-minute time frame. In this place now, let me explain a few things again. When the market gets to this place, when the market move from here, change character to the upside, what I want you to understand is it starts giving us a series of pullback. Now, remember that thing I explained immediately after the basic market structure. It now looks like this, right? You see how it looks like now? This is not a break of structure. Let me quickly explain this. This is not a break of structure. For a break of structure to be valid, it must have a complete. This is not a break of structure. Ask me why. Why? Because a break of structure must break with the body of the candlestick, not the wick. If any break of structure forms with a wick, it means that it's a clear of liquidity. It's not a break of structure, right? It's a clear of liquidity. A break of structure should break in somewhere here, all right? Break with the body of the candle. But if you see these two small lines are called wick. If it breaks with the wick, then it's not a break of structure. So having explained that, let's go continue our business that we are doing, right? So this is still our current swing low, and then this is what our current swing high. This is basically what our trading range. If we are to trade here, this is where we look out to trade the market from. But no, we are not interested in this one. It is very, very good. You can catch some sales from here. It is very, very all right. Like this sale here. If you are a time trader, like we caught this sale when the market gave us this break of structure, we wait here for the market, caught this sale. These are the most simplest ways to catch big moves in the market, all right? Not the 4 hours, but the 15-minute time frame is the best place you can ever trade. So, haven't noticed that this is the current trading range. We are waiting for the market to give us to break out from the swing high or the swing low. The swing high or the swing low. If the market breaks out from this place, we know that internal market structure has changed from bearish to bullish, but now it is still bearish. That is, this is a pullback, and the pullback is still bearish. So let's play price and then see how it works. Let's play price. You see it reacting good. We have HPOS. Now this becomes our swing high. Why is it our swing high? This is not our swing high. This is what I explained earlier. This is not our swing high. This is not our swing. This is our swing high because it is the highest point of this trading range. Now we don't have any business with this trading range. All we are looking out for is the market to pull back to this place and then gives us a reaction back to the downside, right? That is just what we are looking out to see in the market. So let's play price again. Good. What do we see? The market has tapped into our 4 hours time frame points of interest. So what we are looking for is that the market should come to this place, then give us lower prices. But if it does not happen, the market should if the market gives us a change of character to the upside, then we know that these lows are protected. We are waiting for the 15-minute time frame pullback in order to take a trade, right? So let's go down to business. Let's play prices and see what happens. Good. That is it. What do you need to do? No much line, no confusion, nothing. Just us versus the market, right? Remove this one in order to remove any confusion. This automatically becomes what? Our change of character. This has become what? Our change of character. This is our BOS, confirming that the market is no longer interested in going bearish. It is now interested in going what? Bullish. What do? Immediately we mark out our what? Swing low. This is our what? Swing low. Right? Now, let's look for our point of interest. Right? So after the market change character to the upside, confirming that the market wants to now go bullish, what we will do, we'll look for a point of interest. What is the point of interest? A point of interest is a place that the market is interesting to buy from, right? Now, I am looking at 3 points of interest already. We have this one here. I have this one here. I have this one. When we do candlestick explanation, you are going to understand how I get all these points of interest, right? But for now, you should just know that this is our what? Point of interest. A very swift explanation, right? These are the 3 places I'm looking out for. What are the criteria of getting your point of interest? 1, your point of interest must have a fair value gap. 2, it must have liquidity to come and take, or your point of interest is your liquidity. Your point of interest must have liquidity to come and take, or your point of interest is the liquidity. You allow the market to take liquidity from your point of interest before you enter. If the market does not have liquidity at all, but if it has liquidity, okay, your point of interest is now okay. You can now buy from there. So, where is the liquidity that will save this first point of interest? This is the liquidity, right? This is the first liquidity that will save. Liquidity is what? Money that needs to be liquidated. For a buy to work, we need to have somebody that will lose money for something to work. If one person is winning, one person is losing, that is just life. All of us cannot win at the same time. But in SMC, following the way I trade, all of us are going to win at the same time. All right. So this here is the liquidity that will save this point of interest. In case this liquidity is not enough for the market, this becomes the next target. All right. This point of interest will be liquidated. If this point of interest is liquidated, this one is going to hold. This is very, very normal. Let's be realistic. This point of interest will hold. But if this one did not hold, then this place will also become what? Liquidity. If the market liquidate all these points of in these two, then this one should eventually hold, right? But then this is the liquidity that will save this point of interest. And this point of interest, it has a fair value gap, a very unique fair value gap. What is fair value gap? It's a discount in the middle of 3 candles. Now let me explain what this means. It means that when you see, let me expand my candle so that this explanation will be okay. Good. Now look at this. Look at this gap here. This gap. The distance between this gap and this wick. Look at this wick here, this wick, and this one here. It doesn't have a wick at all. This space that this wick refused to align with is what a point, is what a fair value gap, right? This is a fair value gap. And this is a fair value gap. Then this is what? This is also what? A fair value gap. The distance between this candle wick and this candle wick is a fair value gap. But if these wicks have actually overlapped themselves, then you know that there is no fair value gaps here. But these 3 points of interest all have fair value gaps. They all have liquidity to come and take, and they also have what? An order block. So we know that our point of interest is what? Valid. Then, having said that, the next thing is what? We wait for the market to what comes to that very point and see how it reacts from there, right? So we wait. If the market comes here, if it comes here, we are still looking forward to like get validation to take the trade, right? We are not just going to take it blindly. That is what makes this strategy unique and different from all what you see on the internet today, right? Okay, it has taken out this liquidity. Price has actually taken out this liquidity. All right, so we will step down to the 1 minute time frame. in the 1 minute time frame, what we are looking for is this price coming down, the same thing 90 over and over and over again. And when price comes down, gives us series of break of structure. We need to see what change of character to the upside. This is what our change of character. After the change of character, we look for a way to enter the market in a 1 minute time frame point of interest, right? So we want to see this confirmation. This is like a lower time frame confirmation. This is where the last step comes in. Lower time frame confirmation. Lower time frame confirmation is the 1 minute time frame. You confirm from the 1 minute time frame if your interest is really what the market is doing. All right. So in this place, what we want to see is a change of character. After the change, we want to see a break of structure, right? We want to see a break of structure. After the break of structure, we spot a point of interest to sell to buy, a point of interest to buy from our zone. Here is it, something like this. This is what we want to see in the 1 minute time frame, right? Then we are going to take this trade, and taking trade from 1 minute, taking confirmation from 1 minute time frame actually increase your risk to reward ratio. That is why this strategy is very, very unique, right? Let's go down to business. So we are going to step down to our 1 minute time frame. Each time frame looks confusing, but if you check it very well, it is not confusing. It is just the act of reading it carefully. If you can read it carefully, you know that it's not confusing. All right, so this is the 1 minute time frame, and the market has taken the first liquidity, and this is our first zone. So let's play the market and see how everything works here. Okay, the market has actually entered our first zone. What do we see here? We see a break of structure to the downside. We see a break of structure. After a break of structure, we spot our swing high. Then we kindly wait for, what are we waiting out for? If the market is still bearish, it will tell us that it is bearish by coming to this place and rejecting. All right, but if it is done being bearish, it will actually break our swing high. So let's wait and see how it goes. Keep playing price. What do we see here? The market has actually come to this place and then come and give us a new break of structure. We change our swing high from that zone to the highest point of this trading range, right? This is where we are looking out for. What we want the market to do is to actually come here, shift from bearish to bullish so that we can take trade. If the market did not shift, but if it continues to go down, we will know that this point of interest is not valid. So let's keep playing price and see what happens. That is it. We can clearly see that the market has actually changed from bearish to bullish by just this confirmation. See, this is our confirmation, lower time frame confirmation, right? So this here becomes our change of character. As simple as that. This is the best way to read the market. Now, what makes this strategy so unique is that you have low trades to lose. Why? It is because you always get lower time frame confirmation. If you see this change of character to the upside, the next thing you do, you start looking for your point of interest. For me, I would take the sell before the buy. That is covering the external. No, let's spot out our swing low first. Let's not forget to spot our swing low. So this becomes our swing low. This is the lowest point of this trading range, right? This becomes our trading range. This here becomes our trading range. Now we are focusing on things that are happening in this place. So let's go down to business. We have confirmed that this trade now is valid. This point of interest is valid. So let's remove all these ones now. all the things that will confuse us, let's remove them and focus on this one now. So what we want to do is we want to actually look for where we are going to enter this trade from. So we are going to go to 5-minute time frame to see if we can secure a good entry. If we don't see a good entry in 5-minute time frame, then we look for 15-minute time frame to see if we have any good entry. I think answer is no. Let's check 3 minutes. Okay, since we do not have a clear entry in this place, I'm going to take this order block. This is an order block, but it has been mitigated. See it here, it has been mitigated by this wick here, but then we are still going to choose it. The reason why, because this order block has been mitigated, and then we expect market to come back and take liquidity. So market might likely use this low as liquidity. So we are going to mark it in such a way that we are going to also cover half of these order blocks, should in case the market comes back and then refuse to tag us in. And another thing is to be right. Another thing is for the market to tag you into your position, because you might set your entry in a place that market will not reach. It will come and end halfway and then leave after you, after all the stress of refining your entry. Then after that, you look forward, you place your trade. Simple. Place your trade. Keep a reasonable stop loss. For me, I'll keep my stop loss in a way that it will cover this low here. This low must be covered, right? So after covering the low, what we are targeting in this trade is the highs that gave us this low. What we are targeting in this place, first of all, is a 15-minute time frame high. Then lastly, the original external high, right? But judging from the risk to reward ratio, this is a 14 risk to reward ratio trade. For me, I will keep it very realistic. I will take my profit here, right? If I have so many trades running in profit, I can take my profit, 50% of my profit here, and then take the remaining profit here. Another advice is that don't forget to take profit when you see it, because the market might actually change. Don't trade with emotion. Take your profit when you see it, and stop hoping that the market will have pity on you. No, the market will never have pity on anyone, right? So let's go back to the 1-minute time. This is it, guys. We see it and hope that the market tag us inside when it comes back to finish the pullback session. Okay, it has tagged us inside the trade. Now we are on the trade. Let's see how it goes. All right, delivering top notch, delivering. Oh, it almost took us out. That is one thing about trading with the lower time frame. You must be very, very careful. You see, covering this low was very, very important. Sometimes some people will just put it here. I'm not really comfortable with trading with this. It is too close, so I always put it in a very, very realistic way, that even if the market comes to the lowest point of this low, it won't take me out, right? So we keep playing price. You have to be patient. Right? Once the market starts giving me realistic moves, I will move my stop loss to break even. Why? Because if the trade should go against me, I wouldn't lose anything again. Now I have no stop loss. If the trade should get to this place, then I'm off. That's taking me out, alright? But now we can clearly see that this trade has given us over 3 or 4 risk to reward ratio, if I'm not mistaken. So let's go to the 15-minute time frame, lay it out, see how it works. And see the delivery rate, very smooth. See, simple, right? Simple. Let's be realistic. All right, this is a 12 risk to reward ratio trade. If your trade should come to this place and you have over 9 risk to reward ratio, you see that it is starting to retrace. What do? Take your profit. You understand? Imagine placing this trade with a $1,000. $1,000 is 1% of your $100,000, which I will often recommend. If you want to get a profit, get $100,000. Risk 1% per trade. Then you see how it goes. Then you can take your profit here. Anywhere you see that the trade is actually moving in a way that you like, coupled with the fact that it has taken out this high, you can take your profit here, or you leave it here, or you leave it at the external point. But where I will mostly take my profit is here, right? So let's play price and see if this trade works out. That is it, guys. Nice delivery, nice trade, nice everything, right? One sweet thing about this strategy is that you always get lower time frame confirmation. If the lower time frame confirmation is not there, don't place the trade, right? If you are a newbie or you are an advanced person and you are not yet profitable, my advice for you is that choose 3 pairs, maximum 5 pairs. Study them, breathe them, let them live with you. All right, you know when they are about to make a certain move. And one advice I will always give in the forex market is that all the pairs does not follow your strategy. There are certain pairs that follows your own strategy. Look for those pairs, stick with them, collapse with them, and then make your cool money. If you want to trade with me, if you want to join my mentorship class so that we can be catching good trades like this, a phone number is in the description of this video. As I promised from the first video that I'm going to put in a phone number here so that link up with me. I will teach you. Of course, this is not the only aspect of trading that you need to consider before you be profitable. This is just like the basic, where the basic work is. We still have emotional intelligence, we have risk management, and the rest. And if you are new to this channel, subscribe to this channel so that you support the small growing community. In less than no time, we'll start sponsoring traders, buying proprietary term for traders out there to bring them to profitability so they can enjoy the act of trading profitably. Thank you, guys. See you guys in the next video.